Good morning, venture capital. This is Metagame, and today's episode is about the seismic shifts reshaping the investment landscape as we analyze the power players behind nearly $500 billion in deal flow. $4.48 trillion. That's what moved in the second half of 2025, and I'm about to tell you why almost none of it went where you think it did. See, everyone's been watching the tech headlines. XAI raises $5 billion, Databricks closes $4 billion. The AI boom continues, right? Sure. But while you were tracking those flashy rounds, institutional capital was quietly executing the largest rotation in a decade. And if you missed it, you're already behind. Here's what actually happened in H2. Nearly 10,000 deals, 90% of that $4.5 trillion flowing into one category. Not venture, not growth equity, pooled investment funds, multi-strategy vehicles, secondaries, flexible duration products that let LPs park capital without committing to your 10-year lockup. The market just told you something important. It said, we want optionality, not optimism. But that's not even the interesting part. The interesting part is what happened in the sectors nobody was watching. Insurance surged 73%. Let me say that again. Insurance, the sector most VCs haven't thought about since they stopped paying their own premiums. Multiple nationwide private placement variable account filings, each around $10 billion. This isn't InsurTech. This isn't some Series A for a claims app. This is institutional capital formation at scale flowing into actuarially predictable, fee-generating businesses. Why? Because when macro uncertainty spikes and rates stay elevated, capital hunts for structured returns. It hunts for businesses where the math is the moat, and insurance apparently is where the smart money decided to hide. Meanwhile, other energy climbed 86%. And before you assume that means oil, let me stop you. Oil and gas collapsed, down 39%. The market is repricing carbon exposure in real time, and it doesn't care about your energy thesis from 2019. The capital flowing into other energy is going to renewables, grid infrastructure, battery tech, clean hydrogen, carbon capture. The boring, capital-intensive, regulatory-heavy stuff that most venture investors ignore because it doesn't fit a software multiple. But institutional allocators don't care about your multiple preferences. They care about where the world is actually going. So we've got insurance up 73, energy transition up 86, oil and gas down 39. And here's the one that should really make you uncomfortable if you're running a healthcare-heavy portfolio. Other healthcare dropped 39%. The pandemic sugar high is officially over. Telehealth platforms that could improve unit economics got washed out. Consumer wellness apps that raised on engagement metrics instead of revenue got marked down. The healthcare deals that still got funded in Q3 and Q4 were infrastructure plays, EHR systems, claims processing, revenue cycle management, the unsexy stuff that enterprises actually pay for. If your portfolio is overweight in digital health consumer plays, H2 just sent you a message. And the message is, unit economics are no longer optional. Now let's talk about tech, because I know that's what you're really here for. The headline numbers look stable, steady quarter over quarter, but stable is a lie. The tech market didn't stabilize. It bifurcated. At the top, you had mega rounds capturing the majority of available capital. XAI at $5.3 billion in Q3, Databricks at $4.1 billion in Q4, bringing their total H2 raise to $5.7 billion, Synopsys at $2 billion, Ramp pulling in over $1 billion across multiple closings, Kalshi at $800 million. Grammarly approaching $1 billion total. These aren't Series A companies. These are growth equity and pre-IPO rounds for proven winners with clear paths to profitability or strategic exits. The capital concentrated at the top because the capital got selective. Below that top tier, Series A and B breadth contracted. The tourists left. Valuation discipline returned. And if you weren't a top decile AI platform or a growth stage winner with real revenue, your fundraising environment in H2 was brutal. This is the barbell market. Mega rounds on one end, struggling early stage on the other, and a shrinking middle that used to be called Series B. But here's what makes this complicated. Even with all the rotation toward defensive sectors, AI remains the gravitational center of venture capital, and the enterprise adoption data explains why. Gartner's April 2026 survey showed 80% of CEOs now expect AI to force operational capability overhauls. 80%. That's not a trend. That's a mandate. When 4 out of 5 CEOs are telling their boards they need to restructure around AI, you're looking at a multi-year enterprise spending cycle that will dwarf cloud migration. KPMG's data from late 2024 showed 26% of enterprises had already deployed AI agents, with an average AI budget of $124 million, and 67% of executives rated AI spend as recession-proof. This is why Databricks raised $4 billion in a single quarter. This is why Ramp keeps closing $100 million rounds. This is why AI infrastructure companies with enterprise contracts are capturing capital, while consumer AI apps are getting marked to zero. The AI market is bifurcating too. Foundational infrastructure with durable moats, funded. Enterprise platforms with multi-year contracts and clear ROI, funded. Undifferentiated wrappers and consumer apps without retention, washed out. The middle ground disappeared in H2. If you're building AI, you need to be either foundational or enterprise deployed. Everything else is a hobby. Now, what does all this mean competitively? The top 10 VC funds captured 32.9% of all traditional VC fundraising last year. 1/3 of the capital going to 10 firms. If you're not a top decile fund with differentiated access, your LP base is shrinking. The rotation toward pooled investment funds means LPs are choosing flexibility over commitment. They're choosing multi-strategy vehicles over single GP venture funds. If you're raising a new fund, you need to answer a simple question. Why should LPs lock up capital with you for a decade when they can get venture exposure through a pooled vehicle with more liquidity? The answer better be differentiated access, proven portfolio construction, and top quartile net returns. Because we're good at picking companies isn't a pitch anymore. It's a participation trophy. The regulatory environment is pushing the same direction. The SEC and CFTC are proposing to raise the Form PF threshold from $150 million to $1 billion. Fewer smaller managers required to report. Less transparency into the long tail. For LPs, that means increased reliance on top-tier managers with robust reporting. For sub-billion-dollar VCs who aren't top performers, you're becoming invisible to institutional allocators. Every signal in H2 pointed the same direction. Concentration, scale, selectivity. The spray and pray model is dead. The generalist model is struggling. The winners are specialists with differentiated access, or scale players who can write the checks that matter. So let me bring this back to where we started. $4.48 trillion moved in H2 2025. 90% went to pooled investment funds. Insurance surged 73%. Energy transition surged 86%. Oil and gas collapsed. Healthcare collapsed. And tech concentrated into mega rounds while early-stage breadth contracted. This wasn't a market correction. This was a market rotation, and the rotation told you exactly where institutional capital wants to be. It wants predictability, it wants infrastructure, it wants scale, it wants AI, but only the kind that enterprises are actually paying for, and it wants flexibility over lockups. The question isn't whether you understand the data. The question is whether you're positioned for what the data is telling you, because H2 2025 wasn't a scorecard. It was a preview, and the market that's coming next is going to reward the investors who read it correctly. Everyone else? They'll still be chasing last year's thesis in next year's market. And that, historically, is not a winning strategy. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.